Most financial experts in all of the world's major news outlets said that the boom in the housing market in 2021 could not have been a housing market bubble. Everyone is concerned about a potential housing market crash now that home prices are declining at some of the fastest rates we have seen in the past 10 years. You need to understand how we got here if you want to know where the housing market is headed. This is going to be a really thorough video, and I strongly advise you to follow it through the very end because everything I say is going to build upon one another and make it easier for you to comprehend where we're headed. Welcome to Financial Fluence. In this video, we'll talk about the truth about the 2023 housing market crash. Before the 2008 crash, adjustable rate and subprime mortgages made it possible to buy a home with no down payment. Thus, ninja loans were huge and house purchases required no capital. You can get a mortgage without income, a job, or assets. All ARM holders received a low teaser rate that terminated in 2007. In 2008, 30-year fixed-rate mortgage rates reached 6%, which increased foreclosures. The housing market bottomed in 2012. The Fed reduced rates to help the economy. 3.6 30-year fixed-rate mortgages cost 3.6, down from 2008. The Fed supported the housing market to encourage home buyers. Mortgage rates dropped to record lows. The Federal Reserve Bank announced in 2008 that it intended to reverse all interest rate decreases from 2008 to 2012, making a 30-year fixed-rate mortgage 4.5%. The housing market grew steadily. Home buyers spent, boosting the economy. In 2019, the economy moderated. Startups and property values fell. Since the 2008 crisis was 10 years ago, some feared another collapse. To keep the economy going strong, the Federal Reserve Bank reduced interest rates in 2019. To boost the economy and housing market, the Fed cut rates 3 times that year. 30-year fixed-rate mortgages averaged 3.9%. In 2020, the Federal Reserve Bank panicked and cut interest rates. The Fed's zero interest rate slashed mortgage rates. Thus, the Fed sets bank interest rates, and banks determine yours. The Fed set the bank rate while you pay the mortgage rate, or the federal fund rate. The Federal Reserve lowered mortgage rates to 3.1% in 2020 to boost the epidemic-weakened economy. Lower interest rates and mortgage costs made this successful. Home prices increased by 20.6% in 2020 to 2021, while wages increased by 4.9%. 2021. Mortgage rates lowered to boost the economy. Home buyers were drawn to 2.9% 30-year fixed-rate mortgages. Record low mortgage rates affected many. In 2021, earnings increased by 40.5%, while the housing market increased by 19%. As house prices grow, income differences will make buying homes difficult. Housing will become expensive due to rising prices. Interesting developments in 2021 slowed the housing market in 2022. Inflation and perceptions. The Federal Reserve Bank predicted that inflation would end by 2021. Thus, the Fed did not need to lower inflation. By 2021, we were taught that inflation was not temporary and that the 7% rate we experienced in 2021 was the peak. The Federal Reserve Bank didn't need to instantly lower inflation to keep mortgage rates low and develop the economy. Remember that the Federal Reserve Bank intentionally decreased interest rates to keep people buying homes and start this bubble in our economy and other asset classes in 2021 after the pandemic. The Fed promoted growth due to low inflation. Mortgage rates soared from 3% to 7% in 2022, altering the housing market. Thus, mortgage rates have doubled this year, breaking a new record. Inflation didn't peak in 2021 like the Federal Reserve Bank expected. Therefore, mortgage rates surged in 2022. The Fed is combating mid-2022's 9% inflation. They raise mortgage rates to stop inflation, but this hurts the housing market, especially when the Federal Reserve helps the market. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. Home sales have declined due to low housing affordability. 7 months of declining home sales since February's first-time house price drops. Thus, those who thought this inflation was ephemeral and there was no housing bubble now worry about the housing market. Despite a strong property market, recession fears are rising. Reading property market statistics, not news, is the best way to keep current. Watch as I delete this and discuss the two things you should focus on. Rising house prices and mortgage rates are just the start of a housing market crisis. Property taxes rely on home value, thus owning the same home has doubled in 2 years. Today, you'll pay 6.7%, doubling your monthly payments to $2,550 from 2 years ago. Thus, the same home is twice as expensive as it was a year ago, making it harder to buy if your income has not doubled since 2020. This is why so many individuals are struggling to buy a home. Thus, if the home is worth more, your property taxes, insurance, energy costs, and purchase price are twice as expensive as a year ago. For context, if this was the house you could have afforded in 2020 and your income didn't double, perhaps you saw a slight growth in income like most people did, and you can afford a $1,300 mortgage today, that means you can only borrow a maximum of $200,000 today based on this mortgage rate of so many groups of 10% down, meaning you can only pay $223,000. Thus, Domino's first aspect is that rising house prices make home buying difficult. Buyers have options despite rising mortgage rates. Since the financial crisis of 2008, the number of adjustable rate mortgages has reached its peak, and more institutions are looking at their benefits and savings. Homes are unaffordable at 6.7% interest rates. If customers can't pay, banks offer a 5 to 5.5% adjustable rate mortgage. This is the highest percentage of homebuyers using adjustable rate mortgages in 15 years. They don't tell you, or maybe they do, but people don't understand that your 5-year, 5 to 5.5% mortgage is only for 5 years. This 5-to-1 ARM modifies your interest rate based on future interest rates. Your 30-year fixed rate mortgage payment will climb if interest rates rise in 5 years, starting in 2027. 5 years is a long time, so many people bet that they will make more money. Their home will be worth more. They won't have any trouble paying the higher interest rate, or they will. This is crucial because the Federal Reserve Bank wants to limit inflation by boosting interest rates. Until inflation is 2%, they will keep raising interest rates. If you don't have much equity, decreasing property prices could put you underwater. The average home buyer puts down 6%. Recent home buyers only have 6% equity. If the housing market collapsed by 10%, many people would be underwater on their mortgages. Equity means you want to keep defending it. Because you're underwater and don't have skin in the game, you won't have as much incentive to continue paying your mortgage if your income drops. Underwater homeowners don't care. Thus, a recession could hurt the housing market. When property prices decline, employed homeowners are less likely to stop paying. You're broke if property values and salaries decrease. Domino number 2 is housing. Banks gamble smartly. Low down payment mortgages seem dangerous in an overhead property market. Understanding the housing market system to understand the domino effect. Let's say you wanted to buy a house. The bank will lend you money to buy the house, but sell your mortgage to prevent risk. After lending you money, the bank sells your mortgage to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac buy most mortgages. Thus, despite having little money, the government helps them. Taxpayers fund the non-profit government. They invest, earn, and pay taxes. Fannie Mae and Freddie Mac support making the government popular. Banks mortgage and sell properties. Fannie Mae and Freddie Mac will acquire these mortgages to protect banks. When the economy slows, the housing market also suffers, creating a chicken and egg problem. Start with struggling lenders. Some lenders have shuttered or laid off workers because people aren't borrowing. Why aren't home prices decreasing faster now than they're rising? To answer this, you must understand interest, intent, and basic human psychology. People are more inclined and willing to raise their property prices than lower them. Selling your property requires more pushing, pressure, and time than raising the price. The Federal Reserve Bank's decision will determine all domino repercussions. After the 5-year period finishes in 2027, we'll see the cost of the massive increase in adjustable rate mortgages. If the Fed keeps raising rates, the housing market may correct by 2027. The housing market must be underwater without adjustable rate mortgages to collapse. Since they're underwater, they're more likely to escape. Real estate may crash. It all depends on the Federal Reserve Bank's actions in the next 12 to 24 months. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell, and I'll see you in the next video.